Welcome back. Deepak Jasani, Head of Retail Research at HDFC Securities, joins in to discuss the fundamentals of the market. Deepak, hi. Thanks very much for joining in today. Well, let's start by your view on this entire consumption theme that is playing out. Symphony is actually disappointed post numbers which were released yesterday. What's your sense in terms of how you would approach a stock such as that?
Good morning. FMCG has been one of our preferred sectors over some time now. The rationale has been that the urban and rural consumption both have been seeing some sort of a growth, continued growth. The MSP, the monsoon, etc. will have their own impact on the consumption across the country. So that has been our theme, our rationale for being bullish. Now, the early results which came out of the FMCG pack did show a lot of promise. The promises or the expectations were fulfilled. Over the last couple of days, there has been some disappointment. Now, mind well, the last year Q1 had the impact of GST destocking. So, in that sense, I don't know, this time around, it will all depend a lot on the individual companies, how they have sort of done their strategies in the last year-on-year quarter and vis-a-vis that this quarter how it has behaved. But broadly, I think some pockets of consumption has seen increased competition and including from imports. So we will have to be a little careful about which stocks we are bullish on and accordingly take a stand.
Right. Deepak, the other name is Bajaj Auto, which is lost quite a bit. High was 3,400, it fell quite significantly to what, 2650 or so. HDFC, the institutional side, they seem to believe that the volume, they came out with a report titled the volume chase may help. I just wanted your sense. I mean, the general belief is that this is going to hurt, and we've seen downgrades across the board coming in because of that. Do you have a different view on Bajaj and what they said they're going to do?
Yeah, as far as Bajaj is concerned, I think the management came yesterday and clarified about a lot of things. So what they have been saying is they will get aggressive in terms of pricing in the lower end of motorcycles, and they want a bigger, they want to capture a bigger market share in that segment. So as far as the mid and the high end bikes are concerned, they are not going to sort of do aggressive price cuts, and so the majority of the margins would come from there and from the three-wheeler and export business, where I think their profitability and their revenue visibility continues to be as good as earlier. The only issue currently the street has is with the low end, the entry level motorcycles. So our institutional team seems to believe that this is going to be a temporary phenomena, and once the market share expansion is in place, then probably they will come back to the normal margin levels. So that is their feeling, and I think we will go by that.
Okay. In terms of the broader markets, there's even Hexaware, which is actually down 8% post numbers. Would you have a view on a couple of these mid-cap IT stocks at all?
Now, mid-cap IT had a couple of quarters back become more expensive than the large caps, mainly because of the niche areas they operated in, and the early sort of advantage, early mover advantage that they had vis-a-vis the large caps. So now that advantage is probably they are losing out lately, except in a few cases. The larger companies have put their house in order, and now as the numbers of TCS show, in the new areas, the emerging areas, they have done a lot of work. So the higher valuations which the mid-cap IT companies had a few quarters back, I think they will have to come back to normal, whereas the large-cap ITs, I think, will see a re-rating, and have already seen some sort of a re-rating upwards, and may see a little more re-rating as far as the valuations are concerned.
Deepak, thanks very much. We're out of time. Appreciate you joining in with those thoughts and views on a couple of names. I mean, the Nifty is back to being absolutely flat.